All right, I'm going to help navigate slides here, and Sharif and I will co-present. He's going to be your primary presenter, and I'll let him introduce himself in a few minutes. And we'll also want to make sure that we have a chance to meet you. So let's get started. Okay. I'm Angela Silva, and we'll get a chance to talk a little bit more in depth. But wanted to give everyone a background if you may have not been involved in some of our trainings and presentations before. This is part of the Tacoma Capacity Building Project, and we are here to provide information, training, and assistance to nonprofit organizations that are operating within the city of Tacoma area and or providing services. And the priority here is to really strengthen new organizations, BIPOC-led groups, newly funded organizations, and also focus on organizations that are serving the arts, historical cultural organizations, and youth and or science education. So we are here in partnership with the City of Tacoma's Neighborhood and Community Services Department and the Arts and Cultural Vitality Division. So some folks may be here and associated with Tacoma Creates and Tacoma Arts. All right, today we're going to get to know one another, and I love that it's not a big, busy call, so we'll get a chance to hear from you and what you're willing or would like to learn, what you're willing to learn and would like to learn today. We'll also talk about, give an overview of financial goal setting, creating operational budgets, and then kind of wrap up with annual 990 filings. And as we get through today's presentation, there'll also be a chance to sign up with Sharif for technical assistance appointments. We've opened those up today on our calendar, and I'll be sharing that with folks by email as well. Okay. So here we are. We are the presenters today are Sharif and myself. Sharif, would you like to introduce yourself?
Sure, why not? Good afternoon, everyone. My name is Sharif Abdurrahman. I have a few different roles. I'm the finance director for a large nonprofit up here in the Seattle area. I also have 12 years kind of in that sort of role. I also own my own little small business on the side, the Sheriff CPA services. It's called the Sheriff just because everyone always mispronounced my name Sharif as Sheriff, and so I thought it was a little kind of cool way to sort of take advantage of that. Yeah, I mean, I've been involved in nonprofit finances for significant amount of time. 12 years is listed on here, but I've done a lot, almost two jobs during those 12 years. I also have all the AICPA nonprofits certificates. And I do kind of like the full gambit of things from obviously training such as this one, individual consultations, accounting, auditing, 990 tax preparation, personal tax preparation. And I do it all from my palatial studios here in Renton, Washington.
And Sharif is part of our CPIN network, and we love working with him. And I can't say enough amazing things about Sharif. He gets you. So whatever question you might have about your finances, he can help provide some insight. And he's really good at that grant accounting point of view, even though he's a CPA, right? He gets it. He can talk about 990s and taxes and all the stuff. So I don't think there's ever been a challenge question that we've posed to Sharif that he hasn't been able to resource for us. So keep that in mind as you maybe want to request technical assistance or as we go through the slides today. And I'm Angela Silva. I am the CEO of Collaborative Partners Initiative and helping co-present today. So I'm really glad that you guys are here. I'm also a resource to you. I've been in the nonprofit sector for over 20 years working with nonprofits, and also 16 of those years working in grant administration and research. So you're here to learn more. All right, so we're going to get into the next section that we're going to start with or kick off with is financial goal setting. So this is real important. We're still early in the year, and hopefully folks are working on their budgets for this year or have approved them last fall and are kind of fulfilling their budget goals. But this is a good time to kind of learn the tips and tricks of financial goal setting. So Sharif, I'm going to mute and let you present these next sections.
All right, thanks, Angela. And yeah, I'm happy to present this for you all today. I mean, I understand that, finances and budgets, and particularly those within the nonprofit context, as well as, tax returns and all that isn't, right? Like that's not everybody's cup of tea, right? Like everyone is not excited by it, everyone is not interested in it. And so I'm going to do my best today to just kind of walk us through the three sections that Angela talked about, right, which are the financial goal setting section, the operational budgeting section, and then we'll do a little kind of walkthrough of the basics of the 990 because it's pretty important for all nonprofits to know that. All right, so starting here with sort of like financial goal setting. So I think it's always important, even though I think we all know what financial goal setting is, but I think it's important that we have sort of a common definition from the beginning, right? Sometimes we use the same words, but we have sort of like different interpretations of the meaning of the word in the context that we're using it. So for today's presentation, financial goal setting involves identifying specific objectives related to your nonprofit's finances and financial goals and creating a plan to achieve them, right? So we have a mission, right, that our organization is trying to, to uphold. And, we're going to have obviously programs that are in furtherance of that mission. And so that's what we're talking about here when we're talking about financial goals for nonprofits. How do we have the finances, the money, the financing, right, to be able to do all the great things that we're trying to do out in the community? And obviously, part of this is creating a plan to achieve those goals, right? We have to have a plan, right? We can't just, sort of, on a whim and a hope, right? Think that the money is just going to show up, we're going to have enough, and we're going to be able to do whatever it is that we want to do, right? There's always the need to sort of plan. There's the need to, set targets. There's the need for goals. There's the need to have sort of a strategy of how we're going to get there and how we're going to do those things. So obviously financial goals are the same, right? They're the same whether or not we're talking about our individual lives or whether we're talking about an organization, right? It's the same idea, right? You as a person within your family, right? You want what's best for you and your family, right? And as an organization, right, you want what's best for the mission of your organization. So we're all going toward the same end, whether it's personal finances or whether it's organizational finances. And the goals are, then the same. The types are the same, right? They're short-term goals, right? Things that you can reasonably achieve, right, within the next year. So that might be something like increasing your donor base. That might be something like decreasing expenses in a certain area. That might be, a grant for a new program that you want to you want to start this year. Intermediate term goals are a little bit more sort of organizational in nature, but they're not generally your sort of like capital goals, right? So we'll get to the long-term goals in a second, but the intermediate term goals are those things that you really need your organization to be able to do for the next 3 to 5 years, right? Those things that um that help your organization to be sustainable so that you're not running into the every single year at the end of the year when it comes to budgeting season, you're wondering how in the world are you going to be able to fund things. So the intermediate term goals are sort of future looking more than just like the next year. And then long-term goals generally are more sort of capital in nature, right? Like those are for sort of like bigger projects and bigger things that you might doing. Examples of that might be you might be looking to purchase a facility. You might be looking to, really improve your IT infrastructure. Things that are going to be costly, right? They're going to cost. They're going to require finances, probably in excess of what you may currently have, right? Otherwise, you'd do it right now. And they take real sort of strategic long-term kind of planning to make sure that when it's time to make those purchases, that everything is sort of in place. So then when we're talking about goals, right, we want to make them smart, right? And this is something I'm sure this isn't new to to folks in this room, the concept of SMART goals, but we'll just go through it anyway, right? I mean, S of SMART is specific, right? You want to make sure that your goal is specific. Meaning what? Meaning that anyone that looks at what the goal is going they're going to understand, right? They're going to understand what it is that you're trying to achieve, right? It's not some nebulous, opaque thing that, who knows if we got there or we didn't get there, but it's very specific, it's very tangible, it's very easy for anyone to understand. Measurable means that there's the ability for you to measure whether or not you got it or you didn't get it. I'll give you an example. Way back in the day, I used to be an ESL teacher before I did some of this fun work. When I was an ESL teacher, it was required of us to put on the well, nowadays probably was the blackboard, but anyway, the board behind us, that the student will be able to do what, right, by the end of the class. And so if we were talking about, for example, the use of am, is, or are, right, the verb to be, we would put there, oh, given a subject, the student will be able to conjugate the verb to be correctly. So it was easy. We could measure it, right? You could ask a student, okay, he what? And if the student is like he is, hey, we're doing good. If the student is like he am, okay, we're not hitting that, right? We're not able to get it, right? And so you want to make sure that the goal is measurable, that you can measure whether or not you made it or you didn't make it, and there's no sort of um you know area of sort of argument of whether or not you hit your goal or not, right? Like it's a pretty tangible, measurable thing. Achievable, the A, achievable, right? You want to have a goal that's realistic. And, I think folks, when they think of achievable, they look at, okay, well, we didn't set the goal too high. And that's true. But on the other side, you also don't want to set the bar too low, right? You want to have something that is a realistic goal that you're stretching for, that you're trying to get to, but it's realistic, right? It's not, hey, we're gonna get $5 billion by Sunday, right? Yeah, you're probably not getting $5 billion on Sunday unless you got a $5 billion grant that's sitting out there waiting to, where you're waiting to hear from someone, right? So make sure that they're achievable. Relevance in the context of nonprofits, right, is relevant to either the overall mission of the organization, or if we're talking sort of on a more programmatic basis, it's relevant to the achievement of the particular program that you're looking for, right? If we're talking about a youth organization, right, then we want our goals, even those that are financial, to be sort of going toward um you know helping the youth, right? It's a relevant financial goal that's relevant to the mission of our organization. And then the T being time bound, right? Like you just can't have like an open ended goal, right? Okay, well, we want to get like $3 million. Okay, for example, right? Okay, we want to get $3 million. Okay, well, when? Right? Is that like next week? Is that in a year? Is that like in your lifetime? Right? So they have to be time bound, right? You have to have some particular amount of time. And then some folks also, in referring to SMART goals, they also, I didn't include it on the slide here, but they extend it out to make them SMARTY goals, which includes being inclusive and equitable, right? That the goals are also inclusive for everyone and they're equitable for everyone as well. So that's also an important note that I did not include on the slide here. Angela, could you move to the next one? Okay, so when we're talking about like grants and donations, right? So these are like super hard, right? It's super hard when you're sort of setting goals and sort of looking forward, because like, yeah, like you're reliant upon someone else or something else, right? And so let's sort of like look first, right? So your financial goals, as we talked about, they should run in parallel with your programmatic goals, right? So you have, you have your mission of your organization, you have your programs that are in furtherance of that mission. You want to make sure, as we talked about in the last section, that those goals are running sort of in parallel um, with your programmatic goals. So obviously, with nonprofits, the vast majority of nonprofits have three funding sources, right? That's our donations, our grants, and program service revenue, right? Whatever particular programs we run that generate revenue. So when we're looking at donations here, right? So donation goals, right? They should be based on need, right? Yeah, right. What's sort of your need or whatever that you have for the particular project that you want to do, or the particular year or years that you're setting your goals for. And they should be based on, like relevant data, right? So what does that mean? So that means that, when we're looking at donations, we should have some type of framework, through which we're sort of making that determination, right? Like, we're not just throwing darts at a dartboard and saying like, okay, well, we're going to get, 50,000, in January. Oh, it's 70,000 in March. Oh, it's only 5,000 in June, or what have you, right? But rather we have some way of of having data, whether that's looking back, right? Whether that's looking back at how things have been trending in the past, whether that's sort of projecting forward, sort of based on information that you have, right, within, whether that's in your community, whether that's from the people that have been fundraising in your organization, or have been fundraising in the community, even if it wasn't in your organization. And donation goals also have to be based in reality, right? There's other factors that are out there, and we all have dreams that we can get all these donors, and they're all going to give at high levels, and they're all going to do it forever, and that's just not the reality. And so we have to have reality in as part of that. So some things to kind of like think about, right? So a lot of organizations have, right, they have like their regular sort of donor cultivation activities, right? They send people out, they meet with donors, they try to cultivate them, they try to stretch their giving over periods of time, right? So we have sort of that that kind of bucket. Another bucket, though, is the model of having these sort of like big events, right? We're going to have this big event. We're going to invite folks in our community to this event, and we see that one event, this raises a whole bunch of money. So if we did two events, or we did three events, wow, wouldn't that like double the money or triple the money? But the thing that we have to really understand is, oftentimes when we have these type of events, we're inviting the same base of people, right? It's the same folks that would be coming to like all of them. And so instead of you getting double or triple, right, the donation amount, what you might do is you might get burnout, right, of your donors, so that they actually stop giving completely, because there's just so many asks, right, that are being made of them. So that's just one example of something to sort of consider, right? Because that's kind of like a quick one. Like, I see it when I do 990s, right? I see organizations that have like you'll see like multiple of these like fundraising events, and you can just look at the amounts, right? And they trend like down with each subsequent event that they have in a year. And so that's telling me that organization they have only a limited base, and so they're just keep asking and asking and asking from the same group of folks. And then that's the next one that's on this list here is, can that base be expanded, right? Can you expand your donor base? And then if so, right, at what cost to your organization, right? Because sometimes you don't have the money, right? Because you might have to expand your development outreach, whether that's in social media and advertising and stuff like that, whether that's in more people being hired, like whatever it is, right? Often you have to first have more costs, and then eventually that leads to more donors and more giving and stuff like that. But not all organizations are in that situation, and so sometimes you got to think about that. Yeah, we want to expand our donor base, but if it's going to cost us X before we're even able to expand it, maybe that's not something that we're able to do at this point in time, and maybe there's a different a different method, for us to do that. And then we also have to think about outside things that influence donations, right? So we have, the economic climate, right? At the height of the recession back in whatever 2006, 2008 or whatever, across the board donations were down. You name the organization and donations were down during that period of time. So we have to understand that economic climate sometimes can have a drastic effect on fundraising or donations. Sometimes it has less of an effect, but it's something to take into consideration. Political climate, if your organization is an organization that works in areas that kind of like intersect with politics, then the political climate also might have an effect on how things work with the donations in your organization. And donations are often, I don't include it on the slide, but donations are often cyclical, right? Like people like to give at the end of the year so they can get their tax deductible tax deductions rather. And then as the new year comes, January, February, March, people are less likely to give. And then for many organizations, the summer is like the dry months, right? Like it's hard to get money. And so when we're making those goals or whatever, we have to really understand that. We have to understand the cyclical nature of how the money is coming in, because that may, depending on the cash flow situation of our organization, that may have a super important factor, right? That okay, we're going to get all these donations, but if we've spent them before the summer comes, oh, now we don't have any money to do to do our events in the summer. And that's more of talking about short-term goals. Grant funding, right? It's the same concept, right? It should closely align with the mission of the organization, right? And what I indicate here is sort of like two ways that can happen, right? So one way is that the grant is like specific for your mission, right? So again, I'll use a youth group, right? So we're trying to to help the youth, and we have a grant that helps the youth, right? That's obviously an example of where it maybe directly helps your mission. A way that it might indirectly help your mission is to bring in people, right? You might have a grant that provides a service. I'm going to use, there's a grant, for example, that that Angela and I have worked on in the past for like tax preparation or what have you, right? Or small business innovation, right? Okay, so that's not necessarily, neither of those grants are necessarily helping your mission directly, but by having, right, some of those, by having that grant and having some of those services, for example, in your center or whatever, you might be bringing the parents, right? You might be bringing the parents in, and now that they know about your location and all that, now all of a sudden there's more youth that might be coming into your organization, more opportunity for you to to help them. So it's just a small example of where there's a possibility sometimes of a grant that's maybe a little bit outside of your kind of lane, but the benefit of having it is the opportunity to sort of attract more people, to get more people, to have more people that you can help in fulfilling the mission of your organization. The next thing is that like grant funding alone is generally not a sustainable model, right? So grants, so people have this, I think sometimes unrealistic belief. And again, it's sometimes, it's not all the time. So maybe your organization isn't in this particular case, but it's like 95% of the time, right? People have this belief that I'm just going to get grants and we're done, right? We don't have to do anything else. We're going to apply, we're going to get grants, we're going to be fully funded. It's all good. But unfortunately, that's not the way that works, right? Grants often don't cover everything. They don't cover all your expenses necessarily. They may not cover all of your staffing. In some cases, if you didn't read the grant right, it might not cover any staffing at all, or it might only cover a portion of a role, or it might indicate that a particular a particular function has to be hired from the outside, like whatever, right? There can be all kinds of different things that aren't covered by the grant, and then you're sort of struggling to kind of like figure out how you're going to fit puzzle pieces into the missing spots that you need to fill up. And then the other thing with grant funding is like you got to be realistic when you're setting goals, right? I was looking at the projections of an organization, and they had like all these grants. It's like a bunch of them that are out there. And if we look back at their history, maybe they had a hit rate at 40-50% of what they applied for, right? So if you have all these 50 grants that you think you're going to get, but you've only been hitting, you've only been getting maybe a small portion of the ones that you've been applying for. Well, don't set a goal out there that you're going to get all this money in grants, right? Be realistic, right? Just because you set a financial goal of a certain amount, right, for your grants doesn't mean you can't apply for more than that, or it doesn't mean that you're like set on that goal, but it means be realistic about it, right? Be realistic about what your hit rate is, what the real expectation is, how competitive a particular grant is. If there's thousands of organizations going for one award, yeah, it's probably unlikely that you're going to get that grant. Whereas if there's five awards for 8 organizations, okay, then maybe there's a good chance that you're going to be able to get that grant. But again, it's super important to just be very realistic about that when you're setting those goals. The next slide, Angela. Right. We're just going to talk about sort of program service revenue here really quickly. So, obviously, program service revenue is when a nonprofit charges for a service directly related to its mission, right? That's program service revenue. And I'm not going to read through this, but there's the examples that you can see on the screen up there. But it's super important to understand that there's a lot of sort of regulation in what you can and can't do, right? So program service revenue, fees charged and all that type of stuff have to be related to your charitable purpose. They have to support your mission, right? You can't just, okay, our organization is, helping out, is promoting the arts in the city, and we have an auto shop, right? Like that's not going to work. That's not program service revenue. That's not in furtherance of the mission of your organization. And also, when we're talking about more and more program service revenue, depending on the city you're in, depending on the state, because they're all, well, we're all in Washington, but program service revenue is often subject to state B&O tax. It may also be subject to city B&O tax, and B&O tax is just like tax for the pleasure of doing business, right? It's tax for the pleasure of doing business somewhere. Donations are generally not included, right? They're not considered part of B&O tax. Program service revenue generally is considered to be part of B&O tax. So if you're going to be increasing the program service revenue, understand that there's the possibility, depending, right? There's a lot of variables in this, but there's the possibility that that might also lead to you needing to pay B&O tax. In addition, if the program service that you're doing is maybe not 100% aligned with your organization, it's sort of aligned with your mission, but not 100%, there's the possibility that it could be subject to unrelated business income tax that has to be paid as part of filing your 990 with the IRS, and that's at the corporate tax rate. There are some organizations that I've worked with that unfortunately fell into this, and they had to pay a tax on a program that they thought was program service, but the IRS didn't see it the same way. So really make sure that when you have program services and the revenue that's coming from that, really make sure that it is directly in furtherance of the mission of the organization without any doubts, and then you don't have to worry about any of these type of taxes or what have you. But also, when it comes to program service revenue, it's the same as it is with the other two, with the grants and with the donations, right? Make sure that you're realistic, understand the trends that are going on in the program services that you're doing. Make sure that all the goals that you're making, as far as all of the funding from any of these sources, are they're realistic, they're achievable, they're based on some information that you have, and they're not just like we talked about before, not just like throwing darts at a dartboard and coming up with numbers. Next slide, Angela. Yeah, so best practices for financial goal setting, and then obviously tracking, right, throughout the year. So when you're setting your financial goals, right, first thing you have to do is you really have to reflect. Right? What are your motivations? What are the values? What are the dreams that you have? Right? What are the things that you want for your organization? Right? What are the things that you're doing? And obviously, this would be maybe outside also of perhaps even the financial goals. Maybe these would be like a program plan that you have for your organization, right? This is the way that we're gonna, we want to do our program over the next 2 or 3 years. So reflect, okay, we want to do this. Okay, all right, now we have to think, if we want to do that, what kind of costs are there? How much funding are we going to need to be able to, to realistically be able to do that? We talked about this with the SMART goals, but you got to be, you got to be specific, right? You have to have very specific, very sort of narrow goals, right? World peace, right, is probably not very narrow and not very specific, right? Might mean different things to different people. So you want to make sure that your goal is very narrow, it's very specific. As we talked about again in SMART goals, we want to make sure that it's measurable, right? You want to have exact amounts, right, of what we're trying, what we're trying to do, not sort of ranges, not a big range of like, okay, 100,000 to 1 million, that's not really going to work, right? We want to make sure that, we sit down and, we put whatever, pen to paper, finger to keyboard, whatever the vernacular is nowadays, and make sure that we have sort of, measurable amounts, and prioritize, right? Tackle goals in an order that sets you up for long-term success, right? One of the things that we tend to do is we kind of start down one path, and then before we've made it to the end, we sort of move over to the next path, and we move over to the next one. And so we're going to have all these goals. We may have multiple goals that we're trying to achieve, right? But we should prioritize them, and we should do our best to take one, as far down the road to completion as we can before we start another one, and not have sort of like, too many balls that we're juggling at the same time, because often what that does is it makes it to where we never achieve any of them, right? We don't really get to any of these goals because there's so many things that we're out there and we're trying to do. And then, breaking it down, it's like a book, right? I mean, you have a book, and it has a bunch of chapters in the book. If it's broken down into individual chapters, right? I know, like with my kids, right? If I tell my kids, hey, read this large book or whatever, they're like, oh my God, it's too long, I can't do it, it's too difficult. But if I say, hey, read chapter 1, oh, okay, they read that. Oh, read chapter 2, and after, whatever, so many days, they will have read the book that I asked them to read in the first place, by sort of breaking down kind of the steps that are along the way. And it's super, super important to do that. It's important for us as organizations. It's important for staff members also, right? That we can get to a place where we know we achieved A, right? We achieved B, we achieved C, right? It gives a sense of accomplishment, right, to us as an organization, to our staff. Whereas when we have stuff that's like way out there, we feel like we can never get there, like we're never going to get to this goal. And so there's almost like a hopelessness, or whatever, that's there. But when we're able to achieve, kind of step by step, on our way, yeah, it feels like we're getting somewhere. We're doing something. We've accomplished something. Let's move on to the next thing. And when we set our goals, like, we have to track progress and adjust, right? Whatever our goal may have been when we started, right, doesn't mean that has to be the goal through the duration of everything that we're doing, right? And what I mean by that is that sometimes things change, and they change in a way that makes that goal either no longer achievable, or maybe it makes that goal too easy. So let's say, for example, we had a goal to raise, $1 million over the next 5 years. And out of the sky, someone gave us $1 million, or they gave us 900,000, right? Okay, well, our goal might be to raise another $1 million, right? We might have to adjust that, because now, like we're clearly not just gonna achieve that goal, but it's not even gonna be like difficult to do, right? So it's no longer really sort of, something that we're reaching for, right? It's something that's just kind of, sort of like fell into our lap. And so we always want to check what's going on, right? Track the progress, depending on your organization, depending on, the length of the goal, right? Short-term versus medium-term versus long-term goals, but when we're talking like with the short-term goals, yeah, you might want to track those on a monthly basis or a quarterly basis. If you're talking longer-term goals, you might want to track them more on either 6 months to a year, or maybe over a couple of years if it's an extended goal. But you always want to make sure that you're regularly reviewing your goals, and that you adjust as needed, as I said, based on changing circumstances, right? Things always change, right? They always change, but it doesn't mean that small changes should make you change your goal. And I want to just kind of focus on that for a second. Like I'm not talking about just, randomly changing your goal just because you feel like changing it or because there's some small thing that occurred. I'm talking about major changes that occurred. Maybe all of a sudden there's all these grants that are available for organizations just like yours that weren't there before, right? And so maybe that's a major change in your funding model, right? Maybe there's some law that came into place that makes it to where you have to pay staff more money, or you have to give them more benefits, or whatever that might be. Okay, so now our expenses have been changed, and so that's going to affect how many people we're going to be able to have and all this kind of stuff going forward. So when there are changes that are significant changes to your organization, that's when we would be adjusting our goals. Next slide, please. Yeah, and this slide, which we're going to share, just has 4 or 5 different there's 3 articles, I suppose it is, and a YouTube video that just kind of go over all of these things, right? There's the 12 golden rules of nonprofit finance. There's sort of like a financial management self-assessment tool, 10 examples of smart goal setting, and then like how to do it, right? There's like basically a YouTube video that kind of shows you sort of step by step how to go about setting financial goals. And the purpose of our presentation today is to give sort of like a high level, sort of broad overview. As Angela mentioned at the beginning of the video, we do have 3 sessions or whatever that we can do that are one-on-one sessions where we can go over the specific situation in your organization and help you with the specifics that that are there within within yours, right? Because every organization is a little bit different. There's no like one size fits all type of thing. So I'm gonna pause it, I think, there for a second before we move into operational budgets, and just see if there's anyone that has any questions or anything I could elaborate on further. Also just doing a check to make sure people are awake, because I know this stuff is not the most exciting topic in the world. Nathan, I see your hand up.
Hey, I wanted to kind of piggyback off what you talked about in regard to breaking things down into smaller amounts to allow yourself to be successful. And I have a quick example, if I may. I have a house that I bought, and the backyard was just a weed infested mess. And it was a bigger yard. It's a larger lot, and I was overwhelmed by the amount of weeds. And what I did was I said, okay, I'm going to section this backyard off. I'm going to clean those weeds up and then plant new things and growth. And within the year, my backyard is now to die for, with my fire pit and my pergola. But it was just it was overwhelming at first if you look at it, the entire picture. So breaking things down, like you said, in the smaller quantities, it will get you a long ways and not have you as frustrated as you could possibly be. So great point. I just want to make sure that I reiterated that and thank you for breaking down like that. But it definitely does work.
Yeah, I appreciate it. I mean, that's right. That's also, to a certain extent, especially for our younger generation with, smaller things on TikTok and YouTube and all these kind of things of being in the habit of getting things sort of in smaller, smaller kind of doses as well. So, I mean, just overall sort of, societally, right? Not just when it comes to finance or, yard work or, or whatever, but really in every aspect, right? Like we like to get to a place where, wow, I finished this, and now I'm like excited to do kind of like the next section. And I would imagine that that's probably how you felt, doing the stuff in your backyard. Like, wow, this looks really nice. Like I'm now motivated to do,
right,
sort of the next part.
Absolutely. Thank you.
Thanks. All right, we're going to move into the next section here and save probably have time for questions after that. Just housekeeping too, if folks can put their name and the name of the organization in the chat, that will help us as we take notes after the fact. So please do that as Sharif is talking. And now we're going to head into operational budget. So taking it from this broad financial goal setting perspective into revenue and expenses for your organization.
All right, so fun again, the fun and excitement of now budgeting, right? Everyone's favorite. So first we're going to talk about operational budget and we're going to define it, again, one, like I said at the beginning, to make sure we're all working off the definition. But two, because I know there's people that are like, it's just a budget. Why do we have like all these different names, right, for the same thing, right? It's a budget, right? Why do we have to break it down into that budget and this budget and the other budget? To confuse everyone. And so I'm going to go over sort of a couple of the main sort of types of budgets, and sort of maybe going a little bit why like they're the commonly referred ones, right? So an operational budget, which is also called an operating budget, and I'm going to apologize ahead of time. I'm probably going to call it both of these things throughout the remainder of the presentation because they're both used all the time. But anyway, this type of budget focuses on the day-to-day expenses required to run a business organization efficiently, right? And so it outlines the financial plan for routine operations during a specific period. And that's the important part of it, right? Almost always in the nonprofit kind of sector, when we're talking about the budget, quote unquote, the budget, we're talking about what it's going to take, right, to run the day-to-day operations for that organization over the next year. Right? That's what we're talking about, right? And so that's in essence what the operational budget is. And so before I move on to kind of the components and all that, there's all kinds of things in nonprofit that make it different from sort of other types of, I guess businesses, if we want to call it that or what have you, which is that, for example, we might get restricted funding that's particular to, a particular program or a project or whatever. We might get multi-year funding that we're going to kind of, use in different years. We might have some type of investments and some kind of rule on that. Like there's all different types of things. Bequests sometimes occur where, someone, passed away and they left money from their estate to our organization. And so there's all kinds of things that we might get as a nonprofit organization that are like random from year to year, right? One year we get tons, one year we get nothing. And it makes it super difficult sometimes to budget for those things. So there may be ways that we, quote unquote, transfer from restricted or transfer from designated or transfer or whatever it is into our operational budget. And so that's why there's sometimes, different terminology and all that kind of stuff. But here, when we're talking operational budget, it's the budget that that you're going to have for a year in nonprofit, right? And so there's like the two key components, right? Obviously, this isn't unique to nonprofit. This is in every kind of budget, right? So, and that's revenues. And sometimes you'll hear the word revenue. Sometimes you'll hear the word income. And you might be like, wait, what's the difference? Yeah, there's no difference, right? It's the same thing, right? So whether someone calls it revenue, whether someone calls it income, they're talking about the money that's coming in, right? And that's projected income from, like we talked about, donations, grants, program service revenue, and sometimes there's some other sources as well. And then obviously for expenses, we're talking about, again, routine expenses, right? Because we're talking about the day-to-day operations of the organization. So we're talking about routine expenses, right? Office supplies, utilities, salaries. I mean, there's many of them, but that's just an example, right? And so your operational budget should follow your chart of accounts. And so I don't know, as someone that does 990 tax returns, as someone that runs budget to actual reports all the time, I can't tell you how frustrating it is when you have an operational budget and it doesn't match like your accounting system, right? So your accounting system spits out these reports and then you're trying to match up what your accounting system says and what your budget says. And that's just not gonna work, right? It's super difficult, it's super complicated, and it's unnecessary, right? So whatever accounting system you're using, whether you're using something that's computer like QuickBooks, whether you're just using Excel sheets, whether you're using the back of napkins, right? like whatever system that you're using, make sure that your budget, right, is done in the same system with the same methodology so that we're actually able to compare, right, the budgeted amounts with the actual amounts. And then your budget should be reviewed on a regular basis, right? So whether that's monthly, whether that's quarterly, probably shouldn't be less than quarterly. To assure, sort of alignment with the actual expenses, right? And also with the projected revenue, right? You want to make sure that you have sufficient time to make adjustments if adjustments need to be made. And so oftentimes what happens is the finance people maybe will know, right? They might know that, there's a problem, or the, expenses are running too high, or the revenue's too low, or whatever it is. But if the, decision makers aren't given that information, or don't know that information, or aren't, asking, about that information or whatever, it might be too late, right, to make adjustments. And so we always want to make sure that we're regularly reviewing our actual expenses, our actual revenue to our budget, and making sure that, again, if changes need to be made, that we have enough time in order to, to make those changes. Next slide, Angela. Okay, let me move my pictures here because it's blocking my ability to read these. But anyway, so the operational budget. Let's go. Nope. There we go. Okay. So yeah, an operational budget, right, helps manage current cash flow and short-term, financial stability. And right, okay, so we have our budget, right? And we see how our budget's working and all those kind of things, right? And so it looks like, oh wow, like we're doing super good, we have enough money, we're doing great. But what's your basis of accounting, right? So there's two different accounting bases, right? There's accrual accounting, and there's cash accounting. And just a real quick example. Let's imagine that we receive an invoice on December 31st, right? We receive an invoice on December 31st, but we pay it on January 2nd, right? In the accrual accounting, this expense would have been in December when we received the invoice. And on cash basis, this would be in January when we made the payment, right? And so if we have accrual accounting that's going on, it may be that we have received all these invoices, or we have invoiced customers, or we have received pledges, whatever it might be, but the cash hasn't actually come in or gone out. So we might be feeling like, oh wow, we're doing great, we have enough money and all this kind of stuff, but it may be that you don't have enough cash flow because in the accrual basis, right, it's not determined by cash. And so if organizations are using accrual accounting, and basically any organization that's getting an audit, right, from, is getting audited financial statements or reviewed financial statements, you're going to be using accrual accounting, then you might also need to have a cash flow projection, so that you also have, so if you have your report of where you are budget to actual, you might also have to have a separate report that's showing now what does that mean with respect to actual cash flow. And it's just like an important note that sometimes organizations, they don't know, right? Like I do, again, the 990s, and there's a question on the 990, are you on the accrual basis of accounting or the cash basis? And some organizations, they literally will just say in the questionnaire, yeah, I don't know, right? So it's very important to know, right? Is your accounting being done on accrual or cash basis? If it's done on cash basis, then your budget to actuals are fine because they're going to be based on actual cash coming in and going out. But if it's on accrual basis, you might need another type of report that's actually talking about the cash flow. So it's a very important note, especially when we're talking about those like budget to actual reports. And if people are asking like why is one or the other better or worse or whatever, it really kind of depends on your organization, right? I mean, in a world where everything is the same, accrual accounting is better, but not everyone is in that situation. And so organizations, especially organizations that are really struggling with cash flow and really struggling with understanding, how do they have enough money for their payroll and all those kind of things, and particularly organizations that are early in their life cycle, cash basis might be better for them. right? And this isn't something we can just change, by the way, also, right? You can't just go like half year on one basis and be like, I don't like it, I'm going to switch, right? It's a sort of, it's kind of like signing up for healthcare, right? You get your one shot at open enrollment, and that's pretty much it, right? For the remainder of the year. So and again, we could talk about specifics related to that maybe in a different setting. The other main type of budget, other than operational budget, right? So again, right, we're like, oh my God, now there's more types of budgets, right? But this one's important, right? And that's the capital budget, right? Capital budget obviously is focusing on long-term investments and strategic decisions, right? It helps businesses plan for the future by considering major upgrades, replacements, asset acquisitions, larger purchases. And so regardless of whether we're talking accrual or cash basis, because it doesn't matter in this case, when we're buying, something big, we're spending $10,000 on a piece of IT equipment or what have you, that's going to be depreciated over a period of time in your operational budget, right? So the actual purchase of, the IT equipment in this case or whatever, that would be part of a capital budget, which is separate, right, than your operational budget, right? Because those are gonna vary from year to year. There's generally long-term planning that's involved in those. Sometimes there's specific fundraising plans that are specific for those projects that are outside of your normal operational budget, your normal regular budget. And so those type of things show up in the budget, not with the $10,000 that you spent to purchase it, but with, IT equipment, I think is like over 10 years. So maybe like with $1,000 a year for 10 years, that's the depreciation expense of that particular item. Just want to mention that because when we're talking budget, that's not what we're talking about. We're not talking about the purchase of, like long-term capital items in operating budgets. We're just talking about the day-to-day regular operations of the organization. But you'll hear about capital budget a lot, particularly, for like the individual that mentioned like the 3 different healthcare facilities and like these kind of things, right? There's a lot of capital stuff that's going to be going on in those type of organizations, and in smaller organizations, it's probably pretty minimal. Super important thing for nonprofit organizations, right? A budget is a statement of your values, right? You should make sure that your budget is consistent with your mission, your vision, and the values of your organization, right? You want to make sure that, for example, if you're an environmental organization, you don't want to have in your budget grants from oil companies, just as an example, right? Like you want to make sure that whatever way you're funding, whatever way you're expending your resources, that they're consistent with the mission, vision, and values of your organization. Super, super important. Every 990 tax return that you will file with your organization is going to be publicly available. And any large grants that you receive, though the person that gives you the grant might be masked, if you're kind of smart enough, you can sort of follow the trail to other organizations and kind of figure out sort of like where that may have come from and stuff like that. So you want to be really careful to make sure that all the stuff that you're doing is consistent with your mission, vision, and values. Next slide, Angela. Right. So budgeting for revenue versus maybe budgeting for expenses. So the first thing is like, there's not like a way to do it, right? There's no like one size fits all. This is the way, every other way sucks, kind of thing, right? There's a variety of ways, variety of approaches, all kinds of different methods of doing this. And so what the question that's often asked is, okay, should I do my revenue budget and then my expenses, or should I do my expenses and then do my revenue? And what I would say is do them in parallel, right? Do them in parallel. Why? Okay. There's a couple reasons I put on here. So one of them is that you're less likely to try to make something fit, right? Don't imagine budgeting as we're going to sit down. We're like a bunch of us are going to sit down at a table for like 4 hours. We're going to come up with the budget and we're done, right? Imagine it as a process, right? That the budget is a process, right? We're going to take a bunch of information. We're going to reflect on the information. We're going to get stakeholders, to kind of chime in, because they may know something we didn't know, right? We're going to take our time, right, to make sure that we don't forget something, right? And I'll just give you sort of an example that happens sort of like in my family. I'm going to try to talk a little bit slow here so that my partner doesn't hear this, but it's like going to the grocery store, right? So if you go to the grocery store and you just rush in and rush out, right? Okay, I have X amount of time. I'm just going to rush in. I'm going to grab things. I'm going to get out. Inevitably, you're going to forget something, right? It's going to be something that was there that you didn't, that you were supposed to get that you didn't get. And either you're going to have to go back in, or maybe again, like in my case, you're going to get an argument with your partner, or whatever the situation is, right? Something is going to have been missed. When you take your time and you plan, right, and everyone talks and everyone is involved in the process and all that stuff, doesn't mean there's zero chance that something will be missed, but it means that it's much less likely. It mitigates, something that might be important, whether that's from the revenue side, whether that's from the expense side, right? There might be something that's very important that you might have missed because you sort of rushed the process. So I mentioned here then again, right, talking about fitting in, right? Okay. So for example, let's say I did the revenue first, okay, and I get my number, okay, and now when I do my expenses, it doesn't quite match, right? It's not going to work. So I might, feel like, well, I could, if I just spend a little bit less on this, or I just spend a little bit less on that, I can fit it in my budget, right? And what we want to do with our budget is not do that. We don't want to do that from the revenue side, nor do we want to do that from the expense side. But what we want to do is we want to have tangible, data-driven, methods of making sure that of how we came to the numbers, right? So that when we're off, right? Because there's going to be areas where we miss budget, right? So when we're off on something, right, and we see that it's way over or way under what we budgeted, and we look back and there's just a random number that we came up with, well, we don't really know why it is that we might be over or under budget. Whereas if we went through a process and we have stuff that's documented, we can say, oh, I expected that we were going to hire this, professional consulting firm, and we didn't end up needing them. So that's why it's below, and it's going to stay below, and that's good. Or, oh, wow, we only budgeted 20,000 for these people, but we spent 40, And so if we don't have sort of stuff that's backing up the numbers that we got to, and we're just sort of like fitting something in because we thought it looked good, right? Or, oh, I want to make sure that I can pass this, so I think we can spend a little bit more here. Like, document why you thought that, right? Go through a process, right? Make sure, again, that you have the things documented. So when you're doing those reports, right, and something doesn't match, you can like look back and you can understand why it doesn't match. And you can know whether that's a cause for alarm, or whether it's just a timing issue, or whether, hey, it's just great, we got extra, extra stuff that were in the budget than what we thought. And so, like I said, right, if you do it that way, where you're doing them in parallel, right, you're going to come to whatever numbers you come to, right? We got this for revenue, we got this for expenses, and you can imagine that now as like your starting point. Okay, now okay, what do we need to do? Do we need to cut some expenses? Do we need to cut some revenue or increase like what do we need to do in order to get the budget to where we want it to be, right? I mean, maybe we have reserves that we're going to use this year, maybe, whatever it is, right? Whatever the process is, it really makes it, when you do them in parallel, and then you sort of, everybody meets, everybody talks, everybody goes over things, right? It makes it much better, right? It's a better budget. And also it makes it so much easier to look back and be able to understand why something isn't matching than if you just, you're just throwing numbers there. And I can't stress it enough, like, don't rush your budget, right? Like in the organization that I work for, I mean, I feel like we almost go the other direction, right? We're like meeting like all the time about all kinds of things. We got everybody in the meetings, maybe even we go, too much to the other side. But there's a happy medium in there, right? So we don't want to rush it, but we also don't need to, drag our feet and spend, 100 years on the budget either, right? Take a legitimate amount of time, but when we do it in parallel, that really facilitates us doing it. Next slide, Angela. Right. Okay. And so budgeting for revenue, right? I mean, first thing is we got to identify our sources, right? Is there anything new that we expect in the upcoming year that wasn't there last year? And is there anything that we expect to go away that was there before? When we look back, we should use as much data as we have, right? New organizations are not going to have almost any data. Longer term organizations are going to have years worth of data, right? But it's very important to look at the data, right? Analyze it, compare it, whether you're going to compare it by month, by quarter, by year, like what's happening, right? Is your revenue going up? Is it going down? Is it remaining flat, right? And super important to make sure that you remove unusual amounts, right? Anyone, accounting people can tell you. They can go in and they can tell you, oh, wait, in this particular year, we got this big, huge one-time donation, or we had this big, huge thing in program revenue, whatever it is. Remember to remove those when you're doing analysis, right? Because otherwise it's going to skew your thinking. You might think that your revenue is going down when in fact it's going up. It's really just this one outlier that's in there. And remember to smooth that out for seasonal bumps and dips, right? Like not everyone has a calendar or fiscal year. And so if you have sort of a fiscal year that runs, let's say like July to June or something like that, you're obviously going to have, for donations, you're going to have big, huge bumps in like November and December, and then other times it's going to go down. So depending on when you run your reports and what you're trying to compare, it might be that that it's not an apples to apples comparison. And by smoothing out your data for seasonal bumps and dips, you can really have a better comparison. And then the look forward part, right? Okay, so we did data analysis of what happened in the past, right? And that's where we should start, right? You start there. And then however we're going to determine what our revenue is going forward, it's the same thing like I mentioned for budgets in general. Make sure it's something you can duplicate. Make sure it's something you can refer back to so that you know why something is or isn't on budget. And then talk to your people, right? Like we're very like high level budget centric oftentimes in our organizations, right? It's just the top people that are doing the budget, but we're not there doing the work. So sometimes there's things that are that the folks that work for us know that we don't know. There's intricate details that might affect the budget that we just don't know because we're not doing the work on a daily basis. And so, budgeting is, a science because we have numbers and trends and all that kind of stuff, but it's also an art because, there's feelings, there's I know this is going to happen because of this or that. That's based on, there's not something you can touch to say that that's going to happen, but from your conversations or, from, past experience or whatever it is about things that are likely to happen or unlikely to happen. And, again, so budget for revenue by using data and people, and, don't just create the numbers you want, right? Don't just, get what you want, but get, again, what's, smart. And like we talked about with everything else, monitor and adjust. Always monitor and adjust as needed. Next slide, please. Okay, and so then expenses, right? So again, you got to identify all your major expense categories and look at your accounting records, right? Your accounting records, of course, are going to have data, but also look at your bank records, credit card statements. Sometimes you got those like recurring subscriptions, right? Might be that it renews, every 2 years. Might be that it, there might be something that if you look on the bank statement, it's like, oh wow, that's not something I remember. That's not something I thought about. Super, super important to do that. Again, same thing that we talked about with revenue. Are there expenses that you think might go away? Are there expenses that are new, right? Something new that, wasn't there in the past. It's pretty important to divide expenses into indirect and direct, right? So indirect expenses, are things that you can't generally connect to an employee or a program, right? Rent, utilities, loan payments, right? And if you have fewer staff, like the rent is going to be, pretty much the same. Utilities are going to be pretty much the same. Loan payments going to be pretty much the same, right? So these costs are easy to budget year over year because there's not a ton of change, but you don't have control over them, right? Or if you do, it's very limited control, right? So, you have those expenses, and that's kind of like your baseline, right? Like you're kind of starting from there because you're going to have to pay all of those, and you kind of know what those are going to be. Direct expenses, though, are those that can be connected to an employee or a program. So travel is an example, professional development. They're often very different from year to year, and you often have a lot of control over them. And this is often the area where if you need to lower expenses, you're able to do it. Whereas with the indirect expenses, you're often not able to really affect them at all. So the same thing that we talked about with revenue, right? Use the same methods, analyze the data, talk to your people, you know, same thing. Monitor and adjust, don't create the numbers that you want. Next slide, please. Yeah, but then what if I have staff, right? Okay, so staffing is often that's like our top expense, right? In a lot of organizations. Thankfully, there's some organizations where it's a lot of volunteers and things like that, and you don't really have a lot of expense. But oftentimes, staffing is one of the largest expense categories. Number one thing to start, don't hire staff until you have a basic understanding of employment law. There's so many organizations that make errors and get penalties and fines and all kinds of things because they hired people without really understanding what that means. And you don't have to be an employment lawyer, right? There's a lot of resources. I think I have some of them in one of the last slides. There's a lot of resources to just get a basic understanding to make sure that you're ready to have staff. So budgeting for staff means not just wages and salaries, right? You also have to budget for federal and state payroll taxes. Depending on where you are, you might have paid time off that is mandated for you. There might be other benefits that you feel are good for your organization. So when we're talking about employees, we mean all of these things, right? And so you take your salaries and wages, and there's often 10 to 20% additional, right? That's going to be sort of like on top of that. So you might be saying oh wait, but I heard if I just say someone's a contractor and not an employee, right? Well, I don't have to pay all that, right? I don't have to pay the payroll taxes and time off and all that kind of stuff. Well, that's true. If someone is a contractor, that's true. But there are clear rules that distinguish between an employee and a contractor. And there's a bunch of penalties for misclassifying someone as an employee. I'm sorry, as a contractor, when they should be an employee. So again, make sure you understand the law and don't just say, hey, I just want to have everyone as a contractor because it's cheaper and I can have more people. Because if they don't qualify as a contractor, you're setting yourself up for, again, major fines. I've worked with organizations that got back 3 or 4 years, fines or whatever because they miscategorize somebody.
Yep, and that's a good segue. I'm going to go to the how do I budget for contractors slide, so we can compare.
Perfect. Yeah, right. Okay. And so super important again to understand the how they're distinguished, right? So what is a contractor, right? Contractor is someone that's employed by another business. Now it might be their own business, right? They might be self-employed, but they're employed by another business, but they provide services for your organization, right? And so you should make sure that you have a clear plan for when and why you're going to use contractors, right? What's the criteria? What's the method? All that kind of stuff. Make sure that you get multiple quotes before selecting a contractor. Often we just have our, usual suspects and we just keep going to them. Whereas sometimes we could have saved a bunch of money and maybe even found someone better if we put out RFPs and those type of things. Contractors are generally used for specific projects. So you should be able to say, okay, I have this project. I'm going to need a contractor for this project. This is the scope of work for that contractor. And so that's the budget, right? That's how I'm going to determine the budget for that particular contractor, right? It's the majority of the time that's the case, right? There probably shouldn't be a lot of examples where we're using contractors for sort of like ongoing work over many years, right? Unless there's a specific reason, maybe we have a grant writer, maybe we have like an accounting firm, right? There's a specific reason that we're doing it, but the general method or whatever is that's going to be project specific. And like with all expenses, look back historically at your use of contractors talk to the leaders of the projects. They can help understand how many hours and how much you need them and whether you could get on without them and all those type of things.
That's great. I'm going to give Sharif a break to get some water, and I'm going to take you through the next few slides about tools. And these are they're not must-haves, but they're just some options. And so in your technical assistance conversations with Sharif, you can go over QuickBooks. And so we wanted to present some tools that are scalable for newer organizations or even more robust organizations. And QuickBooks is always a great option. And here, QuickBooks has a budgeting tool, and so you can create your budgets in QuickBooks and play around with it, and do all that wonderful tracking that Sharif mentions here. And then if you're setting up your budget for this year, he has some examples of how to select profit and loss or consolidated budget. And again, there's no test here, so Sharif is here as a resource if you guys are setting these up and in your organization. And then what do we like about a centralized electronic system is that you can put everything in there for your profit and loss, your donation, your grant revenue, your expenses, etc. And it will match any report that comes out of the system. So please don't try to do pen and paper math or Excel math and then have your accounting system be totally different. It'll just trip you up in the end. So more slides here about, here's an example of operational budget. We have also Excel tools that you can start with before you get into the QuickBooks or before you get into your accounting system. So please feel free to ask us and we can send those along. So what other tools? We're here, as I said, we're here to provide guidance. We know this is a lot to take in over the lunch hour. Please scan these tools and make sure you understand the difference between employees and contractors, or how to create a budget, etc. If you're not finding a resource, we're happy to be one. All right, so we are going to, now Sharif's had a stretch break, so to speak, have him go through the 990 forms for you.
Yep, and we're just going to go through this pretty quickly and just give sort of like a high level thing. So what's the 990, right? 990 is mostly an informational return that almost all tax exempt organizations have to file on an annual basis, right? Just gives you like information about your organization. Some is financial, other information is not financial. And it's a whole series of forms. There's 3 of them. There's the 990N or the note card, the 990EZ, which is not really easy, and the full 990, which is the longest and most intensive of the series. Next slide. And so which one do I file, right? You might want to ask that question. So the 990N, the note card, less than 50,000 in gross income, right? Before expenses, right? Less than 50,000 in gross income. And you don't have to do anything on this. You basically log into the, like, I think it's pay.gov site, and you say, we have less than 50,000. You click enter and you're done. The 990EZ, there's 2 tests that have to be passed in order for you to file this form. So your gross income is more than 50,000 but less than 200,000, and your total assets are less than 500,000. If you pass them both, then you can file the EZ form. And it's longer. I mean, there's several informational questions. There's some financial information, a couple of schedules. So it's quite a bit more than the note card, but not nearly what the full 990 is. And the full 990 is if you don't meet any of these thresholds, then you have to file the full 990. And it's super long. There's tons of confusing questions on it. It requires extensive financial information. The most important being that expenses must be divided by function, which is program, management and general, and fundraising. For all of these, they must be electronically filed. I think there's another screen after this one, right? Yeah. So the 990, they're due on the 15th of the 5th month after the end of the year, blah, blah, blah. Basically means if your year ends December 31st, they're due May 15th. There's an automatic, no questions asked, 6-month extension that can be filed anytime up to the due date, right? You can just say, hey, I need more time, and automatically you will get it. But if you don't do that and you're late, the IRS recently has been very aggressive in collecting these. So the late filing fee is $20 per day, and the maximum penalty is the less of $10,500 or 5% of the gross receipts for that particular year. As I said, the whole series, whichever of the three you do, must be electronically filed. You cannot send in paper 990s. They will not accept them and will consider it to not have been filed. If no 990 has been filed for 3 consecutive years, then you will automatically lose your nonprofit status. And you'll have to start the whole process over as if you are a new organization to regain your status. So you do not want that to happen.